Hello and welcome to Marcellus Investment Managers webinar on our global portfolio, Global Compounders Portfolio, GCP. As an introduction, my name is Pramod Gubbi. I'm one of the co-founders at Marcellus and I look after client advisory and relationships. I have with me my colleagues Arindam Mandal, who heads our global equities franchise. We've had Jaybir Sethi, who heads our research for the global equities portfolio. And we have with us my colleague Mayank, who also looks at some of the businesses that we'll be discussing in today's webinar. And as the title of the webinar says, today's webinar is all about investing beyond tech, because one of the things that people keep asking us or sort of assume that investing in the US is all about investing in NVIDIA and Tesla and Meta and all the really nice and sexy things that are happening on the tech side. Ironically, my colleagues here on the call have managed to pull off in the last 2 years. It's not a long period of time, but in these 2 years where tech has been on fire without disproportionate exposure to tech, by investing in what might look like really boring businesses, very brick and mortar, old school businesses, they managed to pull off an 8% alpha. Like I said, it's very early days. 2 years is no long period to measure, but given the journey over the last 2 years, where the S&P 500 rally has been very narrow, restricted to a handful of tech companies, it is remarkable that the gents on the call have managed to pull off what they pulled off without any disproportionate exposure to tech. So with that as the backdrop, obviously we'll be discussing the portfolio at large towards the end, but we'll begin the call with focus on how does one go about looking beyond tech in the US. So I'll request Arindam to give us an overview as to how did he go about looking at opportunities outside of tech and build the portfolio that he's built. Over to you, Arindam.
Sure. Thank you, Pramod, and thank you everyone who's joining us. Good evening to all of you. Yes, you're right, and in fact, your team, gives us an idea of what people are asking when they think about investing in companies outside of India, and tech is the obvious choice, as you mentioned. Now, so what we try to do here is that we try to look at some of the largest consistent compounders in tech vis-a-vis some of the companies that we have invested in our portfolio. Not all of them, but just to try to give an idea that the companies that we'll be talking about, they are not like the companies at very early stage of their lives. So they have been there for many years. At the same time, we are not going to talk about turnaround stories, any sort of those things which can disproportionately impact your total return over some time period. So you're looking about companies which have been there for a long time. So let us start with, for example, a company that you all know, Google or Alphabet. So Google again has been there for last 25 years. Has been a great compounder. If you can see the numbers, 23% compounding. We probably all of us know that company, right? Now, similarly, another company, the name of the company is Old Dominion. It's a kind of trucking company, very simple, old school business. You ship your stuff from one place to another. Again, they have been in the business from 1939, so closing in close to 85 years. And no turnaround, nothing, just plain simple old school compounding of earnings, and they have been compounding at a very steady pace of 18-20%. In fact, when you pull the data for last 20 years, which has been great for tech, you might be surprised to know that Old Dominion has actually compounded better than that of Google. Had you invested $1 in Google 20 years back, you would have made say 64. You would have made slightly better had you invested in something like an Old Dominion. It is one of our portfolio companies. Another company, great company, again, Amazon. We really probably cannot think of our life without thinking about Amazon daily, on a daily basis. just look at last 15 years, Amazon had a stupendous run through this time frame. I mean, 29% compounding, great. At the same time, when Amazon started in 1994, uh, just 1 year prior to that, another company that was started, named TransDigm. The founder was Nick Howley. So, again, in a very separate, different sector. So TransDigm is, one of the largest spare part manufacturer for airplanes, and so they have been in the business for a long, long time. Again, just to make sure that you are not looking for 0 to 1 kind of opportunities, kind of just highlighting those. What you're talking about here is long-term value creators. So Nick Howley, again, a founder-led business, and at the same time started as Amazon. If you're interested in TransDigm, $1 back then, you would have made 74, and if you had invested in Amazon, you made 44. Again, probably I've never heard of TransDigm, but it is actually a better compounder compared to an Amazon over the last 15 years. Another one, which is I think even particularly even more interesting, is Salesforce versus AutoZone. Now, Salesforce is a company, probably all of us, anyone running any business, probably Salesforce. It's kind of synonymous to any CRM system that you talk about in today's business world, right? It's the largest CRM company. At the same time, it is truly one of the flagship successful SaaS stories that you hear, right? Now, if I just look at Salesforce over last 10 years, they have done reasonably well, 16% compounding, 4x your money. But Visa, we compare that against something, again, a very boring business, as Pramod was mentioning while opening the call. So AutoZone is a company, has been in business for, close to 30 years, actually more than that. And they have been just selling auto after parts. So basically, if your car is, some part of your car is not working, you go to their store, buy a spare part, and fit in your car. That as simple as that. They have been doing it for last 30, 35 years. And if you just look at their compounding, it has actually been much better than that of Salesforce. And again, these are not tiny companies. They are kind of leaders to what they do. At the same time, they have generated enormous amount of wealth, shareholder wealth over time. So the point is that you know that we know these tech companies because we're probably using them on a daily basis, but the value creation can happen much beyond that.
Thanks, Anandam. Now, these tech companies that you mentioned, they're large global businesses with massive top lines. Uh, and we know how they've compounded because they've become sort of dominating global businesses. Now, in comparison, how do some of these traditional businesses deliver this sort of compounding?
Right. So, I mean, look, one of the reasons that we know these businesses, the large tech businesses, because they're large, right? So they're large not only on top line, but their market caps are also large. And one of the biggest fallacies, probably, in general, people have is that the larger the company, if you're compounding your market cap at a certain pace, then you're supposed to compound your return at a certain pace. Return in sense of share price return. Share price is a per share basis earnings that is accurate to the shareholders. Now, we spoke about AutoZone and Salesforce. So if you just look at last 10 years, I mean, the data will tell you a lot of things. I mean, what we're trying to get into is that last 10 years, if you look at the bottom right part of the table, which talks about market cap, in last 10 years, Salesforce market cap went from $35 billion to around $250 billion, almost 6.5 to 7x at that time frame. Whereas AutoZone, their market cap was probably at starting around 17, $18 billion. It went to $50 billion. Okay, just 3x over that time frame. But if you look at, if you had invested in one share of AutoZone, you would have ended up 6x your money. At the same time, had you invested in Salesforce, you probably have 4x your money. The point is, when you're becoming large, there is a high chance that the equity shareholders are getting diluted. It can get diluted in, at multiple layers actually. So as I said, I mean, you can see from the data, definitely the shareholders probably every year got diluted by around 4 to 5%, right? Just because of you are issuing more and more shares. It can be to your employees, it can be to your, buying a new company, you issue share to them, things like that. On the other hand, what we see is that many of these traditional companies, which are not, growing at this hyper pace, they're just growing at 8 to 9%. They have lot of surplus cash that they are not investing back into the business. So AutoZone kind of business, they recognize this fact and they understand that our business is very much recurring over a long period of time. So if I have a recurring business, I have a very long term view of how much of cash we can make over time. So they can lever up, and what they can do is they can buy back or they can issue dividend at a very high cadence, right? So that actually, as a shareholder, you benefit because they are getting accrued to you, and that is exactly what you see in this. So AutoZone, not compounding their market cap at a fairy pace, but they're actually generating shareholder return at a much more steadier pace.
And these three examples are obviously powerful, but are they outliers, or is this a larger theme that there is a reasonable representation of non-tech businesses and in the top compounders?
That's a great question, JB. So what we did a very simple exercise that, as you said, like we are just nitpicking some of the companies that, that we've invested in. So what we did is we took Russell 1000, which is the, kind of large and mid cap index in US. Russell 1000, 1,000 largest companies in the US, listed companies. And over last 25 years, we wanted to see over last 25 years, which of, if I just take, say, top 25 companies, within the top 25 means top 25 companies in terms of shareholder value creation, right? Total return, CAGR. Which sector, or is it all tech? The tech is the only sector that has actually created value, or you find other companies from other sector that have done really good. So if you look at top 25, almost close to actually more than 70% of the companies are non-tech. If you just increase that a little bit more, almost 80% of the companies are actually non-tech. So top 50 companies, out of 50 companies, 36 companies are not 36, sorry, 41 companies are non-tech. If you take top 100 companies, 83 companies were actually non-tech companies per se. Now, interestingly, I mean, we never looked into it that way, but when you're doing that exercise, one surprising thing that came into our notice, again, we took that 25-year data, and when you're looking through the companies, we found quite a few of our companies which have been there, steady decadal, decadal compounders. We have them in our portfolio. But there's certain actually few companies that came up. Two of them I'll kind of mention here. The 20th ranked company in that entire universe is named Copart. Again, one of our largest holdings. And again, in top 35, number 33 was a company called Waste Connection. Now, internally, I mean, we have a special name for these companies, which we call them NIMBY. So these are the companies kind of operating in sectors. They are far from being sexy. In fact, they're doing something that most of the people really don't want to do. So as we thought about, as we looked into this data, we thought, it might be worthwhile to invite Mayank, who is an analyst with our team, and he has been actually covering these names since we started the team to discuss about, about this entire construct of NIMBY, etc. So with that, I'll just invite Mayank. And Mayank, can you just give us an idea? I mean, what exactly is NIMBY?
Sure, N.I.M.B.Y. Uh, so first of all, NIMBY is an acronym which stands for Not in My Backyard. So if I have to give you an example, let's assume that the municipal corporation of your city announces a plan to open a waste dumping facility near your house. And I'm pretty sure people would not be happy about it, and there would be a lot of opposition because of the risk of bad smell, water contamination, and other environmental issues. So in essence, these waste landfill facilities are something that people do not want in their backyard. And that's what we call as NIMBY. That is not in my backyard. Now, consider a situation wherein a company already owns a large number of these facilities. And that would be a massive competitive advantage because it's extremely difficult to get an approval from new one, because there will be opposition from local inhabitants. There would be difficulty in getting approval from government. So hence, any company which already has access to these kind of hard to build facilities will have a significant competitive advantage. And in our GCP portfolio, we have few names which work on these NIMBY themes. And we are going to look at two of these names. First one is Copart, which handles damaged cars. And the second one is Waste Connection, which deals with residential and commercial waste.
Got it, Max. So you're basically talking about, having some kind of physical asset or say land assets, which are basically absolute necessities, but I mean, human cannot survive without them. But at the same time, you do not want to be physically close to those assets,
Yeah, absolutely
right?
correct.
So
Yeah.
is there a common theme? I mean, that exists from investment standpoint? How do you create value out of these assets?
Yeah. So first of all, there are certain things about NIMBY investing which makes them very, very attractive. First of all, the services that are provided by companies like Copart and Waste Connection, these are essential services. So no matter what is happening in the economy, people are going to generate waste and there are going to be accidents. And hence, the services that the demand for the services that these companies provide is very, very resilient. And these companies provide a cushion during periods of economic downturn. So, for example, if we look at previous large economic downturns like global financial crisis, uh, during which the whole S&P 500 index, the earnings fell by nearly 27-28%. The earnings of these companies fell by 5 or 6%. For example, Copart just fell by 6%, and Waste Connection earnings actually grew by 2 to 3%. So this basically represent how resilient these companies are in terms of their earnings. Other key feature about this NIMBY investing is the ownership of these valuable assets. So like we mentioned that it's extremely hard to open a new landfill or a new scrapyard. And hence a company which already owns these assets has a lot of competitive advantage because there are very huge barriers to entry. It's extremely difficult for people to get for any new entrant to get approval for a landfill facility or a scrapyard facility, and that creates a significant barrier. Uh, the other, besides these two aspects, what we like about Copart and Waste Connection is that these companies exhibit characteristics that we look into good investment opportunities. So both of these organizations have been promoter led, who have been instrumental in the company's success. These companies have followed a differentiated business strategy as compared to their competitors and have positioned themselves in an advantageous manner that allowed them to outperform the market and gain market share. And both of these companies, as we have understood them, we find that both of these companies have very strong organizational culture, and that we consider as kind of a secret sauce for these companies, which has allowed them to consistently deliver strong financial performance year over year.
Oh, that's great. So basically, the first 2 points here, they are tied to the NIMBY characteristics that you're talking about, that, no matter what, we'll be creating garbage or waste, right? As long as the human race survives over time, they'll be creating it. But
Absolutely.
what you're saying is that the assets to store or not to store, I mean, to dispose these things, there is a limited supply of those assets, right? So not only they become a strategic asset, but at the same time, they appreciate in value over time because
Yeah,
there's a cap on the supply side of these assets. So can
correct.
you just run us through the example of Copart? I mean, how and what they did differently to
Mhm.
capture the value?
Sure, sure. So Copart is the world's largest salvage car auction company. Now, I would like to take you through the journey of Copart. So the idea of Copart started with a simple insight by its founder that the value of sum of parts of a car is greater than the value of the whole car. Willis Johnson, who is the founder, he used to own a reseller business wherein he would buy damaged or used cars. He would take out parts from these cars, polish them, clean them, and then again resell in the business. Now, because of being associated with the salvage car industry, in early 1980s, he got an opportunity to buy an auction business from one of his friends, whose children were not really interested in running the so-called not very attractive business. When Willis got this opportunity, he immediately lashed onto it, and because he saw long-term growth potential in the business, and that's how Copart was founded. Now, as you mentioned, that these facilities value appreciate over time. So Willis Johnson, he from the very beginning understood the importance of owning land, and always followed the policy of buying land as compared to leasing it. By using this approach, Copart essentially eliminated two key risks in their business. First of all, they eliminated the risk of rising rental rates in the future. And second, they eliminated the risk of eviction from existing facilities if the current landowner doesn't want a scrapyard in his land. So this differentiated approach actually gave a lot of benefit to the Copart in future. So that we understand when we look at one of its competitors, IAA, which followed a policy of leasing land. And as we moved into the future, what we saw is that the profitability of IAA significantly suffered because the landowners from which they had leased the land, they continuously increased their rental rates. So that was a constant pressure on the profitability of IAA, whereas Copart never faced such kind of challenges. So now eventually Copart expanded their salvage networks. Today they own more than 280 salvage yards, and benefit of as the company expanded their network, they were able to serve not only regional players as well as national insurance companies. And one of the key advantages of having a large salvage yard network was that it helped their bottom line. So one of the key aspects of this business is that they have a very large transportation cost, wherein a damaged vehicle or a vehicle which has been involved in accident has to be towed from the place of accident to their own facility. So by having a larger network of these scrap yards, your transportation cost reduces. So that over time plays out and helps in and that results in improving profitability of the company over time. And I think one of the most interesting thing about this company is the differentiated approach that Copart took in terms of technology adoption. So the company started taking online bids as early as 1998, and they launched a full-fledged online auction platform in 2002. Now, if you think about it, internet was in early stages of adoption way back in 1998, and uh, just to have, and the companies like Google and Amazon were just like coming up during that time. So just to have an idea, to have an online platform for auctioning of cars was just unheard of. And most of the competitors of Copart felt that this was not a feasible idea. However, this decision to transition from offline model to an online model proved to be a transformational move for the company. So what generally happens is that when there is an offline auction, a limited number of people can come to the facility, inspect the cars, and finally bid on them. But whereas when you are doing an online auction, the number of people who can simultaneously bid on a car is much larger. Now, as more number of people bid on a car, you get more competitive bidding that results in better realization of these vehicles. Now, better price realization of these vehicles further attract more number of sellers because they get better price of their cars. Now, as more number of sellers come onto the platform, that again attracts more number of buyers because they have a wider variety of car options to choose from. So this essentially creates a virtuous cycle for the company, wherein more number of buyers attract more number of sellers, which in turn again attract more number of buyers. So this This decision to transition into an online model proved to be really a game changer of the company. It allowed Copart to gain market share and consistently outperform its peers. So if you look at the financial performance of this company through different time periods, the company has consistently delivered 17 to 18% EPS growth rate in an industry which if which if layman thinks about it, does not seems to be an industry where you can make a lot of money. So that's uh, that's about Copart.
Amazing. So if I just think about it, just summarize it. So they have this land-based asset. They found a way to monetize it, and they created not only land-based mode. On top of that, they created this network-driven mode that you're mentioning, right?
Absolutely. So
Getting
they
in more and buyer and sellers. You add services to that, so then you can actually keep on generating astounding wealth over time. Is that fair?
absolutely, yeah, absolutely correct.
Great. So is that something similar that you have seen with Waste Connection, or it is a little bit different?
So Waste Connection, obviously it works in a different market, but the common themes about following a differentiated business strategy comes up in the case of Waste Connection as well. So Waste Connection is the third largest waste disposal company in US and Canada with around 10% market share. Now, despite being smaller than its larger peers, this company has delivered faster organic growth and higher profitability because of its differentiated business strategy. Now, in order to understand this business, I will give you a bit of background about the evolution of solid waste disposal industry in US and Canada. So, if we try to divide the market, it can broadly be said divided into urban and rural markets. Now, as people in the US moved to the cities, there was a growing demand for waste management in the urban areas. Now, because of this growing demand, large number of players enter into the market, driving up the competition. Now, this increased competition resulted in lowering of prices, which in turn resulted in plummeting of the profitability of the entire industry in the urban region. Now, as a result, none of the players in the industry was making any money. Now, what this resulted in is that there were certain players who tried to overcome this profitability pressure by trying to become bigger. So they followed a acquisition driven approach, and this essentially resulted in two or three large urban centric players who have who basically consolidated the market. However, this is only one part of the industry which was looked at. That's the urban market. Now, there was another market, which is the rural market, which was completely ignored by most of the players. So this was a large unserved market, which was, if you think about the key dynamics, was much more attractive because there was lower competition as no one was willing to go into these markets. These markets provided long-term visibility through long exclusive contracts. And finally, these markets also allowed creation of a vertically integrated model. So by vertically integrated, I mean the waste disposal company would own collection, the transportation, as well as the disposal of the waste. So having an integrated model allows to generate enables to generate higher profitability. So these factors were highly, very attractive. And the founder of Waste Connection, Ronald Mittelstadt, he identified this gap and he decided to launch the Waste Connection company in 1998. Now, a very interesting aspect is that Ronald, prior to starting his own company, he worked in another waste management company where he understood that the environmental regulations in these developed markets like US and Canada are continuously becoming more and more stringent. And hence, the compliance cost to meet these regulations is increasing. As a result, small players, small local and regional players, which are generally cash strapped, it would be very difficult for them to basically fulfill these requirements. And hence, those kind of companies would be available for acquisitions. And this is where the Waste Connection capital allocation strategy comes in, wherein this company kept on acquiring 15 to 20 small to mid-size companies each year, increasing its scale, increasing its density of operations, and thereby improving the overall profitability of the business. So that's Those are the key things that that really allowed Waste Connection to outperform market, outperform its peers over long time.
And effectively, these guys identified the market structure correctly, identified which is the attractive part of the market, went there, built an integrated model to juice up margins, opportunistically kept adding to their portfolio through acquisitions. Now, this seems to be a moat which has been strengthened over time. Now, how is that translated into actual shareholder value creation? And then
Right.
probably you can answer that for Copart as well.
Right. So when we look at the long-term shareholder value creation for both these companies, and we have looked at over a long time period. So both these companies have significantly outperformed S&P 500 and have been massive wealth creators. For example, if we look at Copart, over the last 25 years, had you invested $1, it would have become $116. Similarly, if you had invested in Waste Connection, $1 way back in April 2002, it would have become $21 versus $4 or $5 that you would get from investing in S&P 500 index. So that clearly illustrates that over time, the compounding effect of these companies have been, through the acquisition of these NIMBY assets, have been massively value generators for the shareholders.
Thanks so much for that, Mayank. Now back to Arindam for a quick portfolio update.
Sure, Javed. This is quite interesting actually. The scrapyards and landfills looks to be the next set of gold mines actually down the line. Yeah, so just talking about the portfolio. Again, the quarterly, we were ahead of the benchmark by around 2 points through this quarter. That's the 3-month performance. This month was a little weak again. Some random movements here and there, but broadly, the last quarter was kind of quite telling, I would say, in terms of performance of different asset classes per se. So after quite some time, quite few quarters, we saw that the bonds finally outperforming the stocks. So I think S&P, as you can see, was up around 6%. The bonds did 7 to 8%. And we also saw the first rate cut. So maybe that can be explained, the bonds outperformance can be explained by the anticipation of that move. However, looking forward, as we see, we are expecting, as we have been mentioning for last few webinars, that over next 12 to 24 months, we expect that the current economy, which is the current state of economy, has a very big polarization in terms of stock performance in different sectors. So, for example, the AI or the tech-related stocks have been completely hammering it out of the park, whereas the consumer stocks are actually struggling quite a bit. Our best case is that over time, these things will converge at some point of time, because unless the rest of the economy actually picks up, they're not going to be able to spend money on these new age technologies. So if you really want these technologies to take over the world over next decade or so, the other part of the economy has to fire at some point of time. We don't know it when, but having said that, we are seeing a lot of great opportunities that are emerging in certain sectors. For example, luxury is a sector we have invested in already. We own armies, but we don't, there are a few other assets we have been closely watching, and we think that, if the convergence really start to happen, there will be many more opportunities that we can latch to. So yeah, broadly, I mean, when you look at the portfolio, looks, we're kind of as assured as we were, say, 1 year back or 2 year back, in terms of delivering alpha to our investors. So with that, what I'll do is I'll pass it on to Pramod. Over last 3 to 6 months, we have been seeing actually interesting developments that has happened in the regulatory standpoint. So over to you, Pramod.
Thank you. So before I get into the regulatory update, I'd like to announce that we will be taking questions Please feed in your questions into the Q&A box at the bottom of your screen. We'll try and take as many as we can in the time left here. So just to run through what changes we've seen, obviously the taxation change is a big deal. Now, literally, long-term capital gains tax on global equities is the same as that for domestic equities, except long-term is defined as 24 months in the case of global equities and 12 months in the case of domestic equities. Given our typical holding periods generally would beat that 2-year mark as well. Of course, short term remains challenging. Short term remains taxed at marginal rate for global equities, whereas it's 20%. I mean, the difference has been bridged there as well on domestic equities. But again, given our relatively low churn, it shouldn't be that much of an issue for us. The big difference, especially for many of us salaried personnel, is that the tax collection at source that was introduced for LRS in last year's budget, this year's budget has issued a clarification that such a tax collected at source by your bank can be adjusted against your tax deducted at source against your salary. Literally, when you do the LRS, your bank issues the tax collection at source certificate. You can submit it to your employer, and the employer will adjust it against the TDS due over the next coming months. So whatever little cash drag was there, remember this TCS was adjustable against the tax dues eventually, but even that time drag on the cash is sorted in some ways. Now they've also announced that Indian banks can open foreign currency bank accounts out of GIFT City. One of the reasons was, once you do an LRS, you wouldn't want the redemption to come back into your domestic bank account. Obviously, you are investing overseas to fulfill some global purpose, and you wouldn't want the LRS limit to go away. For resident Indians to open global bank accounts was a bit of a challenge. But, I tried it out myself. My ICICI Bank GIFT City dollar account was opened in 2 days flat. I'm sure a lot of other banks would also be happy to open that. So it's a matter of convenience from a global investing perspective. And finally, we've had the accredited investor regime come through, which has meant that if you fulfill the conditions of an accredited investor, which could mean $1 million of overall net worth, $500,000 of financial net worth, or $200,000 of annual income, there is no minimum ticket size. Remember, the minimum ticket size for a PMS in GIFT City is $150,000. Now, to keep a bare minimum, we've kept it at $25,000 for accredited investors. Mind you, there's also a consultation paper out by IFSCA, which is proposing to reduce this $150,000 to $75,000 as well. So there have been a lot of favorable movements regulatorily, and for those who were having issues with one or more of these, you might be heartened to see some of these developments. So with that, I'll open the forum for Q&A. There are a few questions already on the Q&A box. Let me start with the macro pieces first. Although we remain bottom-up investors, I'm sure a lot of you might be having questions similar to this. First, the aspect of rate cuts. So Arindam, Jaibir, Mayank, feel free to jump in. We've had the first rate cut come through after almost 18 months of being talked about. Looks like now the expectations of an accelerated rate cut is going through as well. First of all, does it even concern you guys, given the way you invest? How do you build in potential easing of monetary policy when you look at individual companies or the portfolio as a whole?
I mean, I can start. So, I mean, we are not macro experts, but the rate cut that happened in September was kind of due. And I you said, I mean, of course, there are a couple of rate cuts. I mean, I think we're hearing 25 basis point, two sets of 25 basis point actually for the rest of the year. Again, I mean, for the companies that we've invested in, I don't think the fundamental growth prospect really changes that much, irrespective of the rate cuts are happening or not. Of course, I mean, if the rate cuts happen, they will give some comfort to the consumer, the US consumer. The key macro data that we are looking at is definitely the unemployment data, so which is just nudging slightly above 4% now. So 4 to 5%, if the unemployment rate stands somewhere between that, is actually very good. I mean, we talk about the soft landing, so that is the soft landing. If it goes past that, that is going to be challenge for the economy. And of course, stock market will definitely kind of, react much before it actually does. That is something. But second thing that we have been surprised over time, over last 12 to 18 months, is that the real wage growth, which is basically the wage growth taking out the inflation part, so that has been in the positive territory. And that is probably one of the reasons that, we are not seeing conking off of retail sales or anything like that. Things are holding up pretty well. So as long as, the real wage growth is in the positive territory, then probably, the way we have been trying to play, trying to pick some of the consumer names, etc., going forward, that might be helpful to us. But for now, as you have always said, that we are, we're kind of cognizant of valuation. At the same time, we're cognizant of the companies which can actually deliver earnings for next 12 to 18 months. So our overweight is on the positions that can deliver decent earnings. But at the same time, we have some satellite positions here and there where we think that there might be a cyclical kicker that might come through at some point of time. If we get more conviction on the cycle, we'll probably think about rotating some position around that.
Jabir, do you think, I mean, you look at tech is considered growth, and typically growth tends to perform in lower interest rate scenarios. I don't know how it works, but I guess you're discounting long-term growth at lower and lower discounting rates. Do you get excited by these rate cuts?
So, Prabhat, if you look at the largest tech companies, I don't think one can really make a case that there's a lot of high discount rates priced into them. Where this might show up is in the tail. There's a large portion of the tech universe which is still quite far from where it was in 2021. Some of those assets might catch up, but we don't necessarily see a significant fundamental shift which comes from these rate cuts, unless we end up going back to a near zero rate kind of environment where a lot more of risky behavior gets unlocked. The fundamentals of some of those businesses won't really change with this. It's more a normalization than an easing back to a zero rate environment.
Fair enough. I mean, there you go. Not much change. It's business as usual at Marcellus GCP, rate cuts or not. But let's discuss the bigger macro event that's struck the world in the last couple of weeks. China. I mean, the sorts of numbers they're talking about in terms of the stimulus is just quite enormous. I think various estimates touch already $500 billion, and there's more to come. And the rally's been quite spectacular as well. 35% for a market as large as China in a span of 2 weeks. How do you see this affect your portfolio or opportunities that you look at if China sees some sort of revival in its domestic economy? What implications does it have on the global supply chains? We're talking about that.
Yeah, I mean, it's quite interesting moves. I mean, it would be actually great if the Chinese consumers start to spend, So if you look at, last 3 years, I think since 2021, Chinese saving rates, I mean, the amount of money, they're saving in the bank, that has actually gone up disproportionately. So that kind of talks about, the consumer basically are not, they are concerned about the future of the country. So they're saving up to save them. I mean, to make sure that, they're not in trouble if something goes wrong. Now, if this boosts Chinese consumers, that is actually good for the broader, the consumption economy per se. It's also good for the overall cyclical economy because China drives demand not only in consumer stuff, but at the same time, many of the metals and mining, the commodity side of it, right? So actually, I mean, it's a good thing for the overall cyclical markets, cyclical end markets across the world. Now, I'll not, I mean, commenting on China stock market is quite hard because, the Chinese consumers prospering that really translated into the stock market doing really, really great. I mean, they are now in, I think, 3,500 to 3,400 kind of level. And for last 8-10 years, we have been seeing that, that level has been consistent. Um, so yeah, I mean, from our standpoint, it will be good to see the Chinese consumer reviving the luxury companies that we've invested in. So they'll see some kind of boost in the demand side. I mean, armies kind of companies have never seen a slowdown yet in China. So probably they never see a slowdown. That is good for them. On the other side, I mean, if I just think about Chinese economy, probably they need to do a little bit more than what they have done. If you think about the US economy, how they handled the property downturn or the real estate downturn during global financial crisis, they put around 5 to 10% of US GDP in the TARP asset, in the TARP, right, within that. So what China has done, still way below that number. Probably they have to do more, but the intent is seemingly clear. So we'll see how it plays out. But overall, it is good for the positioning that we have in our portfolio.
Interesting. Just to finish off the macro piece, do you even care about the elections? Obviously, you care about the war in West Asia, but in terms of impact on the portfolio?
No, I mean, it is kind of a risk-off event in my view. It's just an unknown. Once you know it, I think I don't think it matters, to be very fair, in longer term. And we are watching them, but I'm not too much worried about who is winning or who is losing.
Fair enough. Now let's get into the portfolio specific questions, particularly the two businesses that we discussed today. One, in terms of what are the growth prospects for such a business? I mean, it can't be nowhere close to what we're talking about the tech businesses. At the same time, they are capital intensive, and you've shown that they are essential services, but the capital intensive nature could make it cyclical somewhat. What is the cyclicality of that, if at all? And lastly, talked about the barriers to entry beyond capital required to compete. Are there any sort of competitive advantages the two businesses enjoy?
You want to take that, Mayank?
Yeah, sure. So I'll start with, first of all, competitive advantages. So let's take the example of Copart. So we already discussed that owning these assets is a source of competitive advantage. The other major source of competitive advantage for Copart is the large member network. So if we see at present, Copart has more than 1 million members who participate in its auctioning. And that is a major competitive advantage because it's extremely difficult for another player to come in and create such a large membership network, because once you have a large network of members, the suppliers would only go to that platform wherein there would be more aggressive and competitive bidding. And because Copart has a large member network, sellers are willing to come on its platform. That's one of the key competitive advantage besides owning these assets. Second, I would say the competitive advantage is more from a software aspects, is the cultural angle of these companies. So if you think about Copart, it's extremely customer centric organization. So even the founder of the company is willing to roll up his sleeves and drive a truck to go and pick up the tow truck. So this kind of culture to be extremely focused on customer, taking regular feedbacks from customer as to how they can add value to them. That kind of culture has inculcated in the organization to continuously improve itself and make them very strongly integrated with the sellers. Now, when you have that strong level of integration, it's extremely hard for someone else to come in and disrupt you from the existing relationships. So for Copart, those things really form a strong set of competitive advantages. When we look at waste connection, I mean, again, the ownership of landfill is one source of competitive advantage. Again, for this company, in our opinion, the decentralized decision making of this company. So when we look at waste connection as compared to its larger peers, the larger peers like waste management and RSG, they have a very top down kind of organizational structure, whereas waste connection, it's a very decentralized organization where the decision making power is available to the lowest level manager, and that allows the company to respond very quickly to the changing market environment. It allows them to build local relationships and capture new businesses, which is extremely hard in the case of its number one and number two players. On top of that, similar to Copart, Waste Connection has a very special culture wherein they call it as a servant leadership. So servant leadership, essentially the concept is like flipping the organizational structure. So as in, instead of directing the employees to perform, it gives the freedom to the employees that you work in a way wherein you think that's the best value add for the customer as well as for the company. So instead of directing them, it's more kind of a culture where you allow them to perform to the best of their capabilities. And this servant leadership approach, this flows from top to the bottom of the company, and it's one of the key matrices that the company has in it, that the management has in its evaluation criteria. So I would say for Waste Connection, besides owning ownership of their assets, their organizational culture, as well as the decentralized way of working, are the two other sources of competitive advantage.
I think the growth opportunity.
Yeah, in terms of growth opportunity. So when we look at Copart, so if you think about it, the Copart revenue is driven by two broad factors. First is the number of vehicles that are involved in accident and are classified as salvage vehicles, and second is the pricing power. So the primary driver for number of salvage vehicles is the total frequency ratio. Now, over time, this total frequency ratio has gone up from around 6-7% in early 2000s to around 21% at present. So total frequency ratio essentially means that if, let's say, 100 cars are involved in an accident, how many of them are decided to be auctioned how many of them are decided as total and goes to a platform like Copart wherein they would be salvaged. So the percentage number has increased from 6 to 7% to 21%. And some of the sellers on the platform, some of the insurance companies on the platform, the number is as high as 30%. So what we think is that at least this number over long term has the trajectory to reach up to 30%. So that's one source of volume growth rate. Second, a very key aspect of Copart is that they have a very strong pricing power. So if you look at the history of Copart, over the years, they have introduced different kind of fees. For example, they have 3 different tiers of membership fee base, and how much you pay for each membership fee decides how many auctions you can participate in. There are fees like fee for getting inside view of the car, the photographs of the car, fee for transportation of the car, fee for storage of the car. So Copart has created this. I would say for each of the different services, it charges its customer. And over time, what they have done is that they have steadily increased the charge that they take for these services. So the company has a very strong pricing power, which is reflected in steady increase in the price that they charge from their customers for the services they offer. And the second, and on the volume side, the tailwind is from steadily increasing total loss ratio. So the one thing to observe is that Copart, as in, it's not a very acquisition-driven company, and they are. And if we look at the long-term performance of the company has, in terms of revenue growth, it's in 13 to 14% revenue growth. That's just a combination of volume and price. So that basically represents that this business is growing at a phenomenal organic rate. Now, I have talked about salvage business. There's another business that Copart is trying to inculcate, which roughly forms 20% of their vehicles. That's the whole car business. So these are the businesses which are basically, so these are the cars which are used by rental fleet companies who have, let's say, run the car for 10 years and they want to sell it off to buy a new set of vehicles. These vehicles could be from repossessed vehicles from the people who have not paid on their loans. So around 20% of Copart sales comes from these used cars. And this is an area which has been a big focus area for the company over the last few years. The company is trying to really scale it up. And if we think in terms of the size of the relative market, the whole used market is much, much larger. So the company is basically doing very well on their salvage car market, and they're also trying to expand the used car market. The third set of growth opportunity that I would say for Copart is international presence. So I'll give you an example. So Copart entered UK market in 2007 and 8, and with by buying a small operation there, and today they have 80% market share in UK. So that's basically they have completely taken over the market. So similar kind of expansion they are trying to do in the European markets. They're trying to enter into Middle East market. So expansion, geographic expansion is another area of growth for this company. So yeah,
putting it together, is it fair to say that we expect really mid-teens kind of earnings per share compounding over a long period of time, which is lower than the historical 18-20%, but still a pretty good rate of compounding, right?
Yeah, based on our assessment, we think that 14 to 15% EPS compounding is possible for this company for, I mean, at least in the foreseeable future.
Got it. And for Waste Connection, can you just quickly run the math?
So Waste Connection, it's a combination of organic and inorganic growth. So over long term, this company has delivered around 10% of overall revenue growth, which can be divided 50-50 into organic and inorganic. So around 5% comes from organic growth rate and around 5% comes from inorganic growth opportunity. On top of that, the company achieves margin expansion, which delivers another 1 to 2% of growth. And this company deploys the capital after spending for capex and acquisitions. It spends the remaining amount through buybacks and dividends. So that another adds around 2%. So again, for this company, we expect around 12 to 13 to 14% is the range wherein we expect the company to compound over long term.
Got it. Okay.
Great, thank you. That was quite detailed, completed the picture on Copart and waste management. The few questions around the regulatory issues, I think the dollar bank account seems to have landed wrongly. I was talking about a dollar bank account opened in Gift City, to which you still take the LRS route to transfer into, and then you can use that to invest in the PMS, so that upon your redemption, it stays outside or it stays offshore, which is Gift City, and you can make further investments from there on without having to lose your LRS limit in that year. For NRIs, there's a specific question. NRIs, in fact, are not subject to the LRS limit. If you're getting in money from overseas, there is no limit to how much you can invest in the PMS. In fact, you won't be subject to any taxation, subject to any Indian taxation. Remember, the rules of taxation are either the investor needs to be an Indian resident or the asset needs to be domiciled in India. In this case, if you're an NRI investing in global equities, neither the investor nor the asset is domiciled in India. Therefore, you'll be subjected to the taxation of your home country. There's a question on accredited investor. You can either submit documents to prove the conditions that I stated, which is the net worth or the income criteria, or alternatively, you can furnish a certificate from your chartered accountant stating your net worth and income criteria, and we'll be happy to accept that. Now, coming back, sorry, there's a question on whether it's a PMS or an AIF. It is a PMS, which means that we'll open a demat account, a custody account in your name with Interactive Brokers, one of the world's largest brokers, and we'll have a power of attorney to operate that account on your behalf, much like how we would do in your domestic PMS. Yeah, so I think I've covered those. Some wanted to be answered before we wrap up, but we have a few more questions on the portfolio. First of all, Arindam, on the build-up of the portfolio, how is the portfolio split from a market cap perspective, divided between, say, mega cap, large, mid, and small cap? And secondly, are there any portfolio statistics in terms of fundamentals and valuation, for example, weighted average earnings growth of the portfolio or weighted average PE of the portfolio that you can beam up?
Let me try to find that. So to start with, I mean, our allocation was always, not much in mega caps. I mean, I think our highest allocation to mega caps was around 25%. Vis-a-vis, I mean, I define mega cap by, market cap above to $50 billion. If you look at the market, I think the allocation is around 55-60% at times, but for us, it was around 25 to 30% max at max. Most of it is, large and mid side of the market. So that has been the case since we have launched. I can just let me try to find out if I have any statistics ready here. But otherwise, I can give you an idea actually. So at a portfolio level, the weighted P of the portfolio is around 32 forward P, 31, 32. And compared to that, the market is at around 21 and a half. The weighted growth rate, the EPS growth rate of the portfolio is around 18% in the most recent year. Compared to the market is around, I think the forward growth that I'm talking about is around 11, 10 or 11. So the PEG ratio standpoint, if I look at it in that way, the PEG ratio of the portfolio is around, I think around 2 versus market is around 2.1 or 2.2.
Got it. There's a question on whether the portfolio managers and the analysts invest in GCP companies. Yeah, I mean, Arindam and Javid, as far as I know, were investor number 1 and number 2 in the portfolio. Yeah. I guess the analysts also get to invest. I mean, there's a question that the ticket size being large could be a barrier. But I guess we have an option to invest through Crystal, which lowers the ticket size as well to as low as I guess $20,000, $25,000. So no, this is the ethos of the firm from day one when we built 6 years ago. That all leadership team members, founders, senior investment team members have to compulsorily invest all their equity savings into Marcellus's portfolios only. And they can't invest in any other equity products outside of Marcellus or directly into equities. Of course, in the asset classes that we don't manage, people are free to invest, but this is something that we signed up to very early on just to break the whole conflict of interest, align our interest to our clients' interest. So whoever asked that question, thank you for asking that. In terms of portfolio changes, big changes, Arindam, Costco, lovely business. Why would we exit that? Intuitive Surgical, another exit. Any thoughts on those?
Yeah, I mean, look, I mean, those are once in a generation kind of business. They still are, they will be. But the only reason we exited Costco, I mean, it was a big part of our portfolio since we have launched. I think at its peak, it was around 10% of the portfolio. When we exited it, it was around 7 or 8% of the portfolio. It is just valuation, to be very fair. Look, I mean, the business is great. The longevity is really, really, I mean, I don't think not many businesses actually have that kind of longevity, but at the same time, we have to acknowledge the fact that, this business can probably compound it somewhere between 12 to 13% dollar CAGR, but it can do it for a very long, long period of time. Now, how much you pay for that, that is where we kind of debated quite a bit. We understood the reason that it got bid up in the valuation. The reason being, Costco is one of those very few companies that can actually counter a situation when the consumer is in distress, right? So if the consumer are not making, saving that much of money, you basically go to Costco and shop. And that is one of the few business that can actually, during this high inflationary period, they actually thrive during that time frame. Now, of course, I mean, they're delivering numbers, they're doing better than most of the others, right? So they got a bid up and it went to a valuation, went to a position that we are not really comfortable paying up that much. I mean, we exited the business when it was trading at, I think, 50, 52 times earnings or 32 times EV with 30 times EV with the forward EV with the. So yeah, valuation was the only reason. Similarly on Intuitive, again, great business, nothing, I mean, the monopoly still remains there. Uh, we think we exited the business somewhere between 410 to 440, somewhere around that time frame, that share price. But again, we acknowledge, I mean, it's a great business. Again, the valuation is the only thing. The challenge was becoming like, if say Intuitive Surgical falls 10, 12%, then does the valuation give you enough comfort to load it up? The answer was that no. So in that standpoint, we had I think, a tiny allocation, 1.5% allocation. We thought of, why don't we found some other opportunities we think will deliver more value. So we kind of shifted it. But in terms of the businesses, I mean, these are exceptional businesses when you get them, a valuation which is more palatable to us, happy to jump into them.
Right. So flipping it the other way around, businesses that you don't own now, which were historically great franchises, but now sort of taken the beating. I'm talking about the likes of Intel, Nike, Starbucks. How are you thinking on about these three names?
Intel, I leave it to Jabir. But the Nike, Starbucks, I can take that. I mean, Nike, Starbucks. Look, I mean, I'll say that these are the names that you are definitely watching. Not only Nike, Starbucks, there are something like Monster Beverage. There's names like LVMH, right? Those are like great compounders over a long period of time, solid moated business. We're keeping an eye on them. I mean, these are something that we're discussing heavily. On the tech side, Jabir, why don't you give your
See,
view on Intel?
Intel, you would buy it if you have a very strong view on the turnaround of the business. We're not equipped to make that call, so we're not going down that path. If somebody has that capability, somebody can figure out how it will get restructured, how the foundry side will do, how the chip design side will do, what will get sold off. Maybe there might be money to be made there, but that's not really in our capability side.
I guess in some sense, whoever asked this question alluded to that, because in the domestic franchise at Marcellus, we've clearly stayed away from turnarounds off, at least till the turnaround has been established. I guess they're trying to get a sense that, do you guys think any differently? Do you want to be early on a turnaround? Because all three have gone through a pretty bad phase.
I think the way we would think about a Nike and a Starbucks would be very different from the way we would have to think about Intel. Nike, Starbucks, there's a cyclical element to it. There is potentially a structural element to it. With Intel, it's all structural. So you have to have a view on the structure getting solved rather than the cycle turning.
Fair enough. Fair enough. There's one interesting question I want to bring on Copart and waste management. This is to do with their terminal values. So in Copart, if the West, or at least America, is moving from, or the rich world is moving from owning vehicles to opting for transportation as a service, will that sort of shrink the addressable market in the long run, and hence terminal values? Are we even thinking about this?
So definitely that is a consideration. So one of the things that stands out for Copart is that the demand for these used vehicles not only exists in the US market, but as well as outside of the US market. So just to give you a fact that around 35% of the cars that Copart sells goes out of US. So these goes in markets like Central African nations, Nigeria. It goes into Middle East. It goes into Central African nations like Iran, Kazakhstan. It goes into Mexico. It goes into Central America. So the demand side of these salvaged vehicles not only exists in the US as well as it exists outside of the US. So that definitely provide, I would say, elongates the longevity of the business. Uh,
So just adding a bit here, as long as people are still moving around, cars are still moving around on the road, accidents will happen. Now, whether that car is operated by Uber or whether that car belongs to an individual, if it gets into an accident and gets salvaged, it gets salvaged. The worry we have here is around two things. So the first is the entire salvage model shifts a bit for electric. If it gets into an accident, the chances of it getting totaled are much higher than for a regular car. But the way salvage economics work are a bit different. The chain is not as established. Like Mayank was saying, the demand comes from elsewhere in the world, and the demand for this is not yet established. So that's one source of worry. The other is if the whole world goes to self-driving cars and just accidents are no longer a thing, that is an actual existential question. But that's it's like quantum computing. It's not something we really worry about yet.
Fair enough. On waste, again, the question about if we move to reuse and recycle, is there any sort of disruptive threat from there?
So, I mean, reuse and recycle is not something new in this industry. Almost all the waste management players in the US are engaged in. Even Waste Connection is involved in recycling of these things. But the thing is that economics of recycling are not as attractive as uh, dumping the waste in landfills, because that is dependent upon the commodity prices. So prices of corrugated papers, glass, plastic. So those things fluctuate a lot, and hence none of these businesses have really basically focused a lot on building that part of the business. So I mean, definitely all these companies have this recycling business. They make some amount of money on it, and if in future there's a requirement that everyone has to mandatorily shift to the recycling kind of business model, I mean, these guys do have that opportunity to do so.
So Pramod, on Copart, I'll probably add one thing. It might be interesting to you. Is that when I started and first time I bought this company in 2014, at that time, ADAS was a big thing that was coming up that, it will be helping the cars to avoid accident and all. Ironically, I mean, that again, the same kind of questions came on Copart, and what you noticed is that, ADAS was definitely helping, but with ADAS in the advancement of technology, people are spending more time on phones. So the accident rates actually never came down. What happened actually is that because of this ADAS, etc., technologies getting into the car, the chances of getting your car total actually increased, right? Because the car is getting more technologically heavy. So the replacement cost is went much higher. In fact, the second problem was that as the cars are getting more technologically advanced, you don't find mechanics to repair them. In fact, if you think about, like repairing an ambassador versus your car now, it's actually changed manifold. I mean, at that time, you can just take out a certain part and the car got repaired. Nowadays, you go to the garage, they'll be telling you that, you have to replace the entire stuff, right? So that, I mean, again, so when I look at Copart through many time frames, I get amazed that, during every time when this kind of technological shift happens, somehow Copart ends up being in the right side of the shift, right? Similarly, with the EV thing, we don't know how the supply chain will be advanced or so. I mean, they're actually, I mean, if you go to their website, you'll find that, there are a lot of Tesla cars being totaled or being sold, actually. I think I was talking to someone as we have been covering Copart for a long time, and his point was that I'll not be surprised if in 10 years, Copart becomes the biggest reseller of batteries.
Right.
So,
Yeah. No, interesting. Now, except the autonomous piece, I just remember I saw Waymo releasing some data about how most of the accidents with their cars are because the other side was driven by a human being, and it was no fault of theirs. So one day when all cars are autonomous, maybe JB's apprehension will come true that we won't have any accidents on the road. There's an interesting question on what percentage of the portfolio is in China. I'd like to reiterate, this is an entirely developed market portfolio with largely US and Europe. We don't invest in emerging markets, including China. Perhaps the only exception is TSMC, which is Taiwanese, which you could argue whether it's an emerging market at all. But yeah, it's an entirely developed market portfolio. Companies are listed in the US or in developed Europe. They might have global businesses. In fact, I think a fairly significant part of the revenues of the companies in the portfolio are from outside the developed world. In fact, if you look at the second derivative in terms of growth, it could actually be predominantly coming from outside the developed world. So that's a clarification. It is an entirely developed market portfolio here. One last question. I think there's a question of what is the GCP team reading these days in terms of books? Any recommendations for people on the call? Of course, beyond Behold the Leviathan, which is going to come.
So yeah, so I just finished reading. There's a book by Victor Fritz. He's a senior strategist in Macquarie, The Twilight Before the Storm. So he basically is talking about the similarity between the current US economy, the global economy actually vis-a-vis the economy that existed in 1930s or 1950s. So 30s, if it is 30s, then there's certain, bigger things to worry about. If it is 50s, then we're actually good, right? So kind of different ways to look at it. So it's a very nice book. I mean, I just finished reading that, The Twilight Before the Storm.
Thank you. Jabir, any recommendations?
Well, if you want something more depressing to read, there's always Peter Zehan. Any of his books are good, but they're all very doom and gloom.
Fair enough. Yeah, no, Saurabh and I got to attend one of his talks in the US last year. It's quite impressive. And I think he has a YouTube channel as well, which is a much quicker way to get depressed than read the whole book, I guess. Great. Thank you. This is fascinating. Copart and Waste. Thank you, Mayank. Brilliant businesses, brilliant analysis. Look forward to hearing more about such businesses in future calls. But most importantly, thank you all for attending. If there are any questions, particularly about how to get signed up for the portfolio, we'll be reaching out to you. Thanks once again. Have a good weekend.
Thank you.